We are now going to apply time value of money to value the stock of a company. And in this example, we're going to value Allstate. Allstate is an insurance company, does property and casualty insurance, does life insurance. They also have some investment functions as well. I'm not sure exactly what they do, but they're primarily known as a auto insurer and a homeowners insurer as their main lines of business. Interestingly, they used to be part of Sears, and Sears spun them off, and now that Sears is combined with Kmart, is almost out of business. It's amazing the large companies that began under Sears, like Discover Card and Allstate, that are now independent companies and are worth far more than Sears and Kmart combined. So this is Allstate, its own company, separate company. You may have heard of the company Esurance. Allstate is the sponsor of that. And so we're going to value this company, and we're going to do this in two stages. The first, we're going to value it using a given set of assumptions, as you see here, and then we're going to build, in the next video, we'll talk about building a data table so we can get essentially a distribution of Allstate's values. So to value a stock, you walk through this in the notes, and now we get to apply it. So this is a good refresher, and if it didn't make sense in the notes, I think it will, any parts that were confusing in the notes, I think will come to clarity here as you actually apply what we've been talking about. So to get the value of a stock, we have to do two things. First, we have to get the discount rate. We call that KE. We're going to use the capital asset pricing model to do that. So KE is the discount rate for stocks. And the formula we are going to use, we're going to take the risk-free rate plus beta times the market or equity risk premium. And here you can say I use the term equity risk premium, so I'll use that. But equity risk premium and market risk premium are the same. If you go through the class notes and the presentations that explain what we mean by beta and equity risk premium, we'll get into that quite a bit in class. So for right now, if you haven't gotten to those parts of the prep for the class, just know this formula, very simple formula. It's essentially a risk-free rate plus a risk premium, but we break the risk premium into a company-specific piece, which is what beta measures, and a piece that reflects that we're in the stock market. So there's our discount rate. So we need each one of these. We need a risk-free rate, we need a beta, and we need the equity risk premium. So I'm going to put all this in column A, and then I'm going to stretch column A out so that all that fits in there except for the long title at the top. So the risk-free rate for stocks, traditionally we use the 10-year Treasury yield. Remember with bonds, if we were looking at a 5-year bond, we use the 5-year Treasury because that's when it's maturing. Well, stocks don't mature. They're perpetual securities. They last forever and ever until the firm goes out of business. So what's the appropriate discount rate to use there? Most people, and there's a lot of theory behind this we'll talk about in class, but most use the 10-year Treasury. It's just tradition and makes a lot of sense, and we'll talk about it in class. So here you can see that the 10-year Treasury is 2.5%. You can see that the very first line you're given in your assumptions. The beta, we're going to see that Allstate's beta we used 1.1. Again, I'm going to click on this comma up here at the top so that it has 2 decimal places. The equity risk premium we can see is 5.5%. And so all we have to do to get KE is we just have to take the risk-free rate plus beta times the market risk premium. So I'll put risk-free rate in row 4, beta in row 5, equity risk premium in row 6. And so I'll put my KE in row 7, and I'll give you the formula here over on the side so you can see it. So very straightforward formula. Maybe the most popular famous formula in all of finance is the capital asset pricing KE formula. So there's our discount rate, 8.55%. Now, no, right now, Treasury rates are much lower than this. They fell below 1% for the first time in all of history, and they have been staying below 1% for the last several weeks. So it's pretty amazing when interest rates fell below 1%. We've never seen that before. This is a nominal rate. It needs to cover inflation. So right here at 2.5%, if you're expecting 2% inflation, it's not giving you much over inflation. But now that the 10-year Treasury is below 1%, you have to wonder if it's not going to give you a negative return after you take inflation out. But we'll talk about some of that in class. It's a pretty important issue. The second thing we do is the valuation. So we need growth rates. So the growth rate we need a long-term growth rate, and we need a short-term. So the long-term growth rate, we also refer to that as the terminal growth rate. That is, this firm may be growing unusually at an unusual period of pace right now. That's the short-term growth rate, but eventually it's going to meet its maturity. It's going to get to where it's as large as it can be. It can't add any more capacity. It'll just grow as a normal company at that point. And so we need to break up these two numbers. They're given here. When you do your group project, you'll have to come up with your own numbers, and we'll talk about that a lot in class as we prepare for that group project. But here you can see the long-term growth rate we're going to use is 5.5%, which is interesting. It's the same as our market risk premium. That's just pure coincidence. There's no reason those two numbers are related. The short-term growth rate we have here, Allstate's management expects earnings growth to be 10% next year and move to the long-term growth over 10 years. So our short-term growth rate is 10%. And then the next thing, I'm going to give it 2 decimal places so that I'm consistent. And the next thing we need is the H value. What the H value is in the H formula, you'll see is you're asking the question, how long does it take to get from the 10% to the 5.5% growth rate? How long does it take to get from your short-term growth period to your long-term? You can see in this discussion that they believe it's 10 years. It will take 10 years for the growth rate to slowly decline from 10% down to 0.5%. The H value is at 10 divided by 2. So the H value is 1/2 of however long you think it's going to take to get from short-term growth rate to long-term growth rate. In your project, you'll have to come up with an H value, which is probably the most difficult thing to come up with because it's a forecast, and it can be tough to come up with a rationale for why you think it's 5 or 4 or 3. 5 is a pretty high number. Actually, you think for H or for the period itself to 10 years. 10 years is about as long as you want to go with high growth. So we're up about the extreme. After that, it's just a matter of plugging things into a formula. You notice I gave you inflation rate here. We don't need the inflation rate. I do have another model I do use the inflation rate for, but we're not using it in our models here. The last thing we need is the dividend. This is the cash flow for Allstate. And you can see that their dividend is $2. I also gave you earnings per share. We're not using the earnings per share in this example, so you don't have to worry about earnings per share, but dividends, $2. If we had a little more time in the class, I would show you another model that does use inflation and use earnings per share, but we just, the limit of time, we can't do it here. But if you're interested in that model, I have it in other places. You can look it up and see that. But so all we have to do now is put the formulas in. We're going to use a dividend discount model. That says that the value of the stock equals dividend 0, which is the dividend I'm giving you, times 1 plus the long-term growth, all of that divided by, open parentheses, the KE minus long-term growth. It's essentially a perpetual growth annuity. The other model we'll use is the H model. There it says that the value of the stock, I'm going to copy this over. You don't remember all these formulas, you don't have to put them in your version of your Excel. So this one is almost identical to the dividend discount model, but we're going to add one section. So here's the dividend discount model, dividend 0 times 1 plus long-term growth divided by KE minus growth. We're going to use that exact same formula. We're going to put a parenthesis around the numerator, and we're going to add a section in that has dividend 0 times your H times short-term growth minus long-term growth. And by doing that, we will get the value of the stock to include both growth rates. So essentially what we're saying is, what's the value of the firm if it's cash flow? The cash flow is the dividend that it pays. If that cash flow grows at a constant rate, what will it be worth? Or if that dividend grows at a constant rate after H times 2 years, but before that grows at the short-term growth rate, declining down to the long-term growth rate over H times 2 years. So these two formulas will give you the value of the stock. Obviously, the H model should give you a higher value than dividend discount model because your cash flows will be higher. So let's put that in there, the dividend discount model. Its value is, so we'll just do it exactly like it's written here. So our dividend is $2 times, open parentheses, 1 plus our long-term growth rate, close parentheses, divided by our KE minus our long-term growth. I'm going to put that in dollars, and I'll copy that over so you can see the formula. Hopefully you're on all the same rows that I am on. $69.18. And then we'll do the H model. The H model is going to look very similar. We need to start with an open parentheses. We'll do it just like we did the dividend discount model. In fact, if I were you, I would do the dividend discount model and maybe add the H in after it just to make sure you did it correctly. Or you can actually bring this formula as a starting point. Just kind of copy the exact formula down. But so dividend 0 times 1 plus the long-term growth rate plus dividend 0, look at the formula, times my H times short-term growth minus long-term growth, close parentheses twice, divided by KE minus long-term growth. And you put a $sign in front of that. Now I can actually check this because the only difference in these two models, so you see that the difference is $14.75. So let's try that, because the only difference in this is dividend 0 times H times short-term growth minus long-term growth divided by KE minus long-term growth. That should be the difference in my two prices. And if I look at it, sure enough it is. So here I took the H model minus the dividend discount model, and that difference was $14.75, and that difference should have been everything in the formula except for that very first part, the dividend 0 times 1 plus the growth rate. So I just want to check and make sure I got the right answers. So there's my two valuations. So what we'll do next time in the next video, you'll notice in the problem discussion that you're supposed to do a data table using these ranges. I'm a big believer in using ranges, data tables when you value stocks. It's true, we think this is probably what Allstate is worth, but we have a lot of uncertainty in our growth rates and our discount rates. So rather than just doing point estimates, in the next video we'll actually do a data table so we can see a full range of scenarios. But there's the answer for Allstate, and so your other company, you just plug in the numbers for that company and you will get the valuation for the second problem.